If you've spent any time in crypto trading, you've heard the word perps, perpetual futures. They're everywhere and for good reason. Perpetual futures have become the dominant trading instrument across much of crypto. On many major venues, perp volume consistently exceeds spot by a wide margin. But a lot of people trade them without fully understanding how they work. Today we're going to fix that. We're starting from scratch: what perps are, how the funding rate works, what leverage actually means, and what you're trading against when you open a position. By the end of this, you'll have the mental model you need to trade intentionally. Let's start with the basic definition. A perpetual future is a derivative that lets you take a leveraged position on any asset without an expiry date. You can go long or short. You can hold for seconds or months, and you can amplify your exposure by 10 times, 100 times, or more, all without ever owning the underlying asset. The no expiry date part is what makes perps different from standard futures. In a standard futures contract, you agree today to buy BTC at a specific price on a specific date. On that date, the contract settles and the trade is done. A perpetual future never expires. The contract stays open until you close it. But that creates an obvious question. If there's no settlement date forcing the perp price to converge to the spot price, what keeps them aligned? The answer is the funding rate. The funding rate is the mechanism that keeps perp prices anchored to spot. Here's how it works. When the perp price trades above spot, more buyers than sellers, bullish sentiment, long holders pay a small fee to short holders every few hours. That payment increases the cost of holding longs, which encourages arbitrage and pushes the perp price back toward spot. When the perp price trades below spot, bearish sentiment, more shorts than longs, short holders pay longs. Same principle, opposite direction. The funding rate is continuous arbitrage pressure. It's not a price control. If traders believe an asset is going to keep rising, they'll willingly pay a high positive funding rate to stay long, and they often do. What the rate tells you is the cost of holding a position in a particular direction, and the degree of sentiment skew in the market at that moment. For active traders, this creates its own opportunities. When funding is high and positive, longs are paying shorts. If you take the short side in a crowded long market, you're being paid to hold that position. Understanding funding direction is part of reading a perp market. Now let's talk about leverage. This is the concept that makes perps powerful and the one that trips people up most often. Leverage lets you control a position larger than your deposited collateral. If you deposit $1,000 and open a 10 times long on BTC, you're controlling a $10,000 position. A 5% move in BTC's price creates a $500 gain or loss, 50% of your collateral. A 10% adverse move wipes out your collateral entirely. The math is simple. Position size equals collateral times leverage. Profit and loss equals position size times the percentage price change. Higher leverage amplifies everything: gains, losses, and the speed at which you can reach liquidation. A position at 100 times leverage gets liquidated on roughly a 1% adverse move, depending on maintenance margin requirements and fees. A 5 times position has much more room to breathe. Here's the thing people get wrong about leverage. It's not inherently dangerous. What matters is position sizing relative to your total account. A professional trader running 100 times leverage on 1% of their portfolio has less total risk than someone running 5 times leverage on their entire stack. Leverage multiplies exposure. It's your position size, as a fraction of total capital, that determines how much of your account is actually at risk. Perps give you two directions to trade: long and short. Going long is a bet that the price will rise. You profit if it goes up, lose if it goes down. That's familiar territory for anyone who's bought spot. Going short is a bet that the price will fall. You profit if it goes down, lose if it goes up. And this is where perps become fundamentally different from spot trading. In spot, your only path to profit is price appreciation. You buy, you wait, you sell higher. Perp markets make both rising and falling prices directly tradable. This is why perps are the core instrument for three types of market activity. Speculation, taking directional views on any asset. Hedging, you hold BTC in a wallet while shorting perps to be market neutral. You keep the asset but remove the price risk. And arbitrage, exploiting price differences between venues or between perp and spot. These three use cases explain why perp markets attract so much more volume than spot on most major venues. They're more flexible, more capital efficient, and available for any asset that has a price feed. Now, and this part matters more than most traders realize, let's talk about what you're actually trading against. Different perp venues use fundamentally different settlement models. Understanding which one you're on changes how you think about execution, liquidity, and risk. The first model is the order book. You're matched against another trader. A buyer needs a seller. This is how most centralized exchanges work and how some on-chain dexes are structured. Liquidity is thin when active participants are scarce, but spreads are tight in deep, well-populated markets. The second model is the LP pool. A liquidity pool acts as the counterparty to every trade. LPs deposit capital and the pool takes the other side. When traders lose, the pool gains. When traders win, the pool pays out. Open interest is capped by how much capital is in the pool. Most major perp dexes use some version of this model. The third model is the protocol-managed liquidity model. Instead of an external LP pool, the protocol provides a virtual liquidity layer that acts as the settlement mechanism. Trades reference Oracle prices for execution and mark-to-market. Liquidity is managed through the protocol's own mechanism rather than through third-party capital deposits. In this model, open interest scales with protocol risk parameters rather than with the size of an externally supplied LP pool. Each has real trade-offs. Order books offer tight spreads in deep markets but thin out fast in low liquidity conditions. LP pools can provide readily available liquidity, but they introduce a structural tension between LP returns and trader outcomes. When traders consistently win, the pool pays out. Protocol-managed liquidity models remove the external LP dependency, but place execution and settlement responsibility entirely at the protocol layer. That means the quality of the Oracle feed, the liquidation engine, and the protocol's own risk parameters become the critical variables. The protocol is the counterparty infrastructure, and its design quality is what you're trusting. Before we close out, let's talk about collateral. Your collateral is the capital you put up as security for your position. If the trade moves against you past a certain threshold, the protocol liquidates the position to recover that collateral and protect the system from bad debt. This is not optional, it's automatic. Most perp venues accept stablecoins as the primary collateral type. Some also accept the chain's native token or other assets, typically with a haircut applied. A token worth $1 might contribute 80 cents of effective margin, reflecting its own volatility and liquidity profile. Collateral type matters for two reasons. First, it determines what you're actually holding as security. A volatile asset as collateral means your margin value can shift independently of your trade, and you can get liquidated even if the trade itself is going in your favor. Second, it affects your liquidation risk in ways that compound with leverage. Understanding what you're posting and that asset's own price risk is part of managing a position properly. Let's close with a quick reference summary of the terms we covered. Leverage is the multiplier on position size relative to collateral. Margin and collateral are the same thing, the capital you post to secure the position. A long profits when price rises. A short profits when price falls. The funding rate is the periodic payment between longs and shorts to keep the perp price anchored to spot. Liquidation is the force close when your collateral falls below the maintenance threshold. Mark price is the Oracle referenced price used for profit and loss and liquidation calculations. And open interest is the total value of all open positions on a venue. Perps are the most flexible instrument in crypto, but the leverage mechanic means understanding liquidations before you use significant size. When liquidation triggers, how it's calculated and what you can do to manage that risk, those mechanics are covered in depth in the next episode. We'll walk through the exact math. Thanks for listening. If you found this useful, share it with someone who's been trading perps without fully understanding the mechanics. See you next time.